Hello, Business 630 Finance Online. This is Professor Hassey. This is the concluding video of our week number 1 of our Spring 1 session, our Friday update video. It's being produced this Saturday, February 5th, so I apologize a day late. I sent you an email accordingly. I ran into some technical issues yesterday, but we got them fixed. And now we're back on the beam. So the purpose of these videos, and as I explained in our first video, is I will give you 2 videos a week on our online class. The way you can interact with me is a student hours every Thursday night, which I do not record, but those are student hours where you can come on and ask me any questions or concerns of the week's topics or activity. But there will be 2 videos produced each week. One which will be posted every Monday, which is my weekly lecture video. And then a end of the week video like Friday, or this week it's Saturday, where I go over the topics of the week and also concentrate on any, if we're having case study that week, maybe concentrate on some issues regarding the case study. Since there's no case study this week, we'll just be reviewing our introduction topics for this week, number 1. So that's the process of our class. Remember, this is an online class. There are no remote, there are classrooms. There's no getting together in a classroom or a Zoom setting for a class. This is all online activity, but to aid in your learning, 2 videos produced each week on Monday and at the end of the week, Friday. So that's how we work it. Now, a couple of administrative issues this end of the week one. Let me just bring up our Blackboard site here. One moment, please. There's Professor Hassey this early Saturday, looking a little shaky at best, but let's quickly get him off the screen. Okay, a couple of administrative issues. I hope you've had time to go through the Blackboard. Remember, you have a discussion post this week. The discussion post this week is to give a little bio about yourself and to tell me a company that you have selected that you would like to follow, track throughout our 8-week course. And the question in regard to the company is find and locate the beta of the company, which is a subject of our discussion this week. So many of you have already answered, and I have replied to your postings. Some of you have yet to do that, so please make sure this is due Sunday evening at midnight. So make sure you get your work posted by then. I have also posted a second discussion forum this week, and I mentioned this to you last week, is in week number 2, I would like to meet with each student in our class for 5 or 10 minutes individually, just to make sure you're okay with the setup of the class, you have any issues or concerns, and also just to get to know each other as we begin this online learning. So we've already had 3 students sign up for the dates and times. So what I like you to do this weekend is please go to this forum, open it up, create a forum, and select a date and time that fit into your schedule where you can meet with me during the upcoming week ahead. A variety of different times. If none of these times fit your schedule, let me know and we will set up a time perhaps next weekend to meet meet. So again, if you can't meet during this week with this schedule, let me know and we'll pick another time later on next week. One thing to note, there is a special link to this session. There it is right there. It's not the links of our Thursday night session. It's a separate Zoom link. So make sure when you do sign up for the session at your individual date and time, you look and note the Zoom link for that session. So please do that this weekend as well, just so you can sit and spend a couple of minutes and chat with me. I ask you questions about, is your technology okay? Do you have any Wi-Fi issues? Is the format okay? Do you understand what we're doing? Just things like that. So I look forward to meeting with you all in the coming week. Another one of the things I'd like you to do this week is read this article that I've provided from the Harvard Business Review. It's a little dated, it's 1993, but the topic is is pertinent to what we are beginning to discuss and look at this week and going forward into next week and future weeks of our course is efficient, chaotic. What's the new finance? The new finance of credit ratings, the new finance of globalization, the new finance of different currencies, not just the dollar being the predominant way of trading. How are CFOs and investors dealing with this new finance? In this article, it talks about capital asset pricing model, which will be the subject of my discussion in a little bit. That's a key number to be used. It's going to be one of the key numbers that you're going to be finding in your case number 1 work beginning this week. And speaking of case number 1, I will post that case Sunday evening. That's tomorrow, February 6th. I will post it Sunday evening. It is due Sunday, February 13th. It will be the purpose of my lecture course, one of my course lecture points next week, but I'm going to post that a little bit early, posting it on this coming Sunday in the afternoon. So you have a 1 full week to work on that case. And the case evolves around a credit analysis of the company that you've selected in your discussion forum in week number 1. So this kind of sets up the case, this article. So I want you to read it. It gives some theory, it gives some explanations, and gives some counterpoints to credit and risk analysis in finance. So I want you to read this article as a prep for week number 2. You know, one of the key things about finance is, as we've talked about, is one of the principles is maximizing shareholder value. And from that, you have to determine how your company is increasing in value going forward. And that's a key thing. Companies need to grow. Companies need to expand. Companies need to create return on an ongoing basis. Return on an ongoing basis to satisfy the needs of creditors, to pay back principal and interest, but also, and more importantly, satisfy the needs of equity investors, stockholders, venture capitalists, hedge funds, Shark Tank, all those people who have equity stakes in our organization. How do you satisfy those needs? Is you increase the value of the company. You increase the value of the company by providing cash flow in relationship to what it cost you to get that cash flow. And that's the subject this week. Our subject in week number 1 is risk and return. What is investment return? Investment return measure the financial results of an investment. And I'm sure a lot of you have stocks or a lot of you have savings accounts. How do you know the return on those investments? Well, the dollars you get in return, the dollars you get when you sell them. And those dollars and those returns can be in percentages, it can be in dollars, but an investment return is the return off the asset of the investment. And for companies, you have to provide investment returns for your shareholders, or you're not going to be in business too much long. What's a dollar return? For example, I invested $1,000. It is sold after 1 year for $1,060. That means I made a return of $60. In percent, that is a 6% return on our investment. One of the key highlights, and this is kind of simple, but one of the key points of this is that you want to earn a return greater than what you invested in. And the same thing holds true with investors issuing or investing in companies. The chief financial officer and the financial managers want to produce a return to give them a positive return on the dollars that they gave you to manage or to invest in their assets. At the same time, there's a risk to investing or a risk to capital fundraising, the risk of default, the risk of failure. So investment risk exposure reduces and makes very difficult that chance of earning that return. The greater the return, it needs to be the greater the risk. In other words, if I want to earn 20% off an investment, the likelihood of that happening is going to be very little compared to if I want to earn 5% off an investment. That's the investment risk. For example, why do we invest in savings account that only earn less than 1/4% a year? because it's safe. There's no risk. We put money in the savings account. We know it's always there. We can draw it out whenever we want to, but we're earning very little return because of that low risk. How do we earn a greater return? We invest in stocks. We invest in mutual funds. We invest in pension plans. We invest in real estate. We invest in all other types of investments. But then again, the returns are greater. Why? Because the risk of failure is greater. All right. You can look at the risk of return of a probability of failure, the probability of returns very easily in investment. What are we going to generate? Different case or different probabilities. That's one of the key things for investors. What's the likelihood of failure? What's the likelihood of success? And then there's probability distributions. Now we're going back, we're beginning the discussion of what beta is. Beta is a statistical analysis of the probability of a good return off a given investment. In other words, if I say my beta is 1.5, that means that statistical average shows that I have a greater risk of earning my designated return than if I would find a company with a beta of 1 or a beta of 0.5. The higher the beta, the greater the distribution of probability of failure. And that's a key point for investors. And beta, fortunately, in this class, we don't have to worry about the statistical calculation. We just have to know what beta represents. The higher the beta, the more likely we won't get our returns. The spread, the probability distribution is greater. Notice in this line, the average is about 8%. As you go out from that 8% return, the risk of getting that money decreases. So that's what risk is. It's the deviation from the average, the deviation from an average of what you should be getting. So when I look at the beta of 1.5, that's in comparison to the average return in the market. In other words, I'm going to be, by investing in this company, I'm going to be hopefully getting a greater return, but I have to assume the risk of maybe that not happening by the beta of 1.5. Whereas if I get an expected return of a beta of 1, that means it's going to be the average risk of what the market is getting. And actually, we compare these risks to various different types of investments. One of the things we talked about in our opening PowerPoint and on Monday was the risk-free interest rate, the 10-year United States Treasury yield. That's called the risk-free interest rate. Why? The beta is 0. There's no risk. Notice the current Treasury yield jumped up at the end of this week to 1.8%. That means you can invest in a 10-year United States Treasury of $1,000 and get $18 a year for those 10 years. Then get your $1,000 back at the end of those 10 years. $18 at no risk. There's no chance of you losing that money or not getting that money. That's why the interest rate's so low. But if I wanted to get a higher rate of return, 5, 10, whatever percent, the beta would go up from 0. Yes, you still might be able and probably will get that return, but the risk is greater. Right now, the average return in the stock market, the S&P 500, is around 8.5, 8.75%. That is the beta of 1. Beta of 1 is the average risk of return in the market. So if I look for an ETF or a mutual fund and invest in the S&P 500, they're going to tell me I'm going to get about an 8.5% return on my investment, and the beta and the risk of that is 1. Whereas if I could buy a 10-year United States Treasury yield at 1.8%, the beta on that is 0. Oof. No risk, but very low return. Average risk about 8.5%. And this risk return correlation is how we go to our individual companies and see what their risk is in the market. And that's why I'm asking you to find the beta of your chosen companies this first week. It gives you an indicator of their risk and return in the market of their last 4 or 5 years of investment returns on a quarterly basis in comparison to the S&P 500. So if your company's beta is greater than 1, that means they've been a little bit inconsistent. They've still been making money, but it's been a little bit consistent to the average of the return in the market. Or if your beta is under 1, meaning they've even been better in their performance and their consistency to the average compared to the market. That's what that represents. And this historical data is the beta calculation. Some analysis go out 4 years, some analysis go out 5 years. This is the information relative to that. And that leads us into what is called the capital asset pricing model. The capital asset pricing model takes a look at our company risk, in this case, stock I, to the risk of the market. It's called the market premium and the risk-free rate. So the capital asset pricing model takes a look at our risk relative to the other risk. So let's say somebody came up to me and says, Rick, I want to earn some money. All right, great. I want to make a good return. Okay, what would you like to make? Oh, I'd like to make 10%. Ooh, okay. Well, 10% leaves us some risk there, because if you told me you wanted a return of 1.8% and no risk, we'd buy a 10-year United States Treasury. If you wanted a return of 8.5% at average risk, we would put it into an ETF or a mutual fund in the S&P or the market. But if you want a 10% return, that means we have to find a company or a group of companies that have a greater risk of failure and are willing to pay higher returns to attract you as a customer and an investor in that business. Welcome to the United States and the world stock market. You want to get return, you got to take the risk. The capital asset pricing model is one of the ways of determining that risk. There's a question in the case number 1 where I ask you to take the beta of your company and calculate the capital asset pricing model and the risk of your business as a return percentage. And that's this calculation here, where it's taking the investor return over time and comparing it to the risk over time. And that's the capital asset pricing model. And here's the formula here. The required return on a stock is equal to the beta of the return of the stock in the market plus the risk-free interest rate. And and there it is right here. In other words, if I expect a return on my stock, that is going to equal to the risk-free interest rate plus the market premium, which is the market rate of return minus the risk-free rate, times the beta of my company. And I'm going to highlight this a little bit more in my week number 2 video, but that's the rate that you're going to try to determine for your company. I'm going to give you the risk-free rate. I'm going to give you the market rate of return. From there, you'll be able to calculate the market premium. You've already looked up the beta of your company. Using that beta, you can calculate the expected return of your company in the market relative to the risk of your company, relative to zero risk and market risk. So this is a very important equation in our early weeks of our class. It tells us of the risk relative to the market of our particular company. So here's an example. Here's a company where the risk-free rate is 4%. All right. The market premium is let's see, make sure I get this right. The market premium is 5%. The beta is 0.6. Okay. Thus, 4% times 60% of 5. 60% of 5 is 3%. 4 plus 3 equals a expected return of 7%. So in this problem, they give you the market return as 5%. Excuse me, the market premium as 5%. That must mean that the market return rate is 9%, because 9% minus the risk-free rate of 4 gives us the market premium of 5%. But in this case, it's given to you. And they give you the beta. So again, if I know the risk-free rate, 4%, if I know my market premium, 5, if I know my beta, 0.6, I can determine what investors demand from my investment in my business, 7%. You are going to do this calculation in case number 1 for your company very briefly, along with some other information you're going to be looking for. But it just gives you in a percent what is the market right now saying to cover the risk of your particular company as a return item in the market. Now, one of the reasons I had you read that finance article this week is it talks about the pros and cons of the capital asset pricing model. Is it a good analysis of our risk of our particular company? CFOs want to know what's going to attract capital. Thus, they always want to know what's the required rate of return in the market based on the risk of their companies. That's why a lot of times you read in companies selling off assets, selling off some of their businesses or acquiring new capital. They're cleaning up their balance sheet. They're cleaning up their returns so they can get a better beta, because the lower the risk, the cheaper their money is in the market. Most corporations use this capital asset pricing model to determine their return. But there are pros and cons to this, because one of the things about capital asset pricing model is that it's based on the past. It's investors are looking for information about the future, but it's using past historical data. Historical data is fine, but is it be able to predict the future? Remember, the beta of a company is going back 4 or 5 years of expected returns. The risk-free rate is the expected interest rate on a 10-year treasury today. The market premium is the return on the stock market today. There's no mention of the future in any of these numbers. So investors have to take a look at trends. What's the trend of expected return? What's the trend of beta in the company, so they can see where the company is going up or down in relationship to returns. Okay, it's a difficult calculation for the future. It's a great calculation about where we stand today based on historical data. So that leads us into what we're going to be talking about next week. Next week, we're going to be looking at, okay, we now get that concept, we get that concept of risk and return. We know the greater the risk of a business, the higher the return to the expected earnings investor needs to get, be it credit or an equity investment. And we learn how to calculate that equity investment in the capital asset pricing model. You're going to be in case number 1 next week, doing a credit risk analysis of the company you have chosen. More on that when I post this on Sunday and with my course video for week 2 on Monday. And then we're going to be able to correlate the future, not the past, with risk and return in chapter 6 and capital asset pricing model. That's using past data. How can we look at future data, future money? And that's the time value of money, present value, future value, annuities, amortization. That's the topics of our discussion next week 2. What's the value of stock? What's the value of bonds? How do we gauge that value of equity and credit in the market? Because once we get these 2 weeks done, in week 3, we look at financial statements, and now we have the basics of strategy going forward of finding investments and corporate finance, maximizing value. We know what our risks are. We know how to interpret risk. We know what the future value of money. We know what our financial statements tell us about our current financial position relative to our past financials, relative to our market, and relative to our competitors. That gives us the basis to begin capital budget analysis and financial strategic decision-making later on in our course. So as we wrap up week 1, please select a company, tell us a little bit about yourself in a bio, pick a time to meet with me next week to talk about these things and review the definition of risk and review the definition of capital asset pricing model. We use all these in our discussions in week 2. So thanks, everybody. Have a great weekend. Sorry we were a little late with this Friday video, but that's okay. It's the first week. Give me a little slack. Have a great week. Stay healthy, and we'll see you. Look for my posting of case number 1 on Sunday evening, and then look for my video Monday for week 2. Until then, adios.